All right. Welcome to episode 2 of the Spatial Show. My name is Elliot Golan. By day, I'm a senior vice president in the real estate practice at Allison, a global marketing communications consultancy. Here with my esteemed co host.
My name is Vladimir Bosanac. I am the other co-host here, and also by day publisher and co-founder of the Registry, a West Coast commercial real estate news organization. Elliot, welcome.
Yeah, good to see you again, man. So, today's guest is someone that I think people are really going to like hearing from. And there's a multitude of factors. One, he's an economist. People love economists, they share really important information. Two, he's between jobs, so he can be a little bit more transparent, to be polite about it.
Let's hope.
Um, and three, he's a bit of a contrarian, which everyone loves. Um, so the topic is going to be, housing, all things housing. We're fresh off NMHC. Obviously, both presidential candidates ran with housing as a central part of their platforms. Obviously, they approach it from kind of different perspectives. But I mean, it's the narrative nationally, even outside real estate. I would say that housing is among the narratives.
And we're going to solve it here in this podcast, right, Elliot?
Oh yeah. The whole like affordable housing thing that like it's not penciling for developers. Well, just listen for
Stay
5 more minutes and I'll
Stay
fix
tuned. This will be
Yeah.
resolved today.
Yeah.
No, it's obviously a big topic, and I am very curious to hear kind of what is happening, and to listen to our interview later on in the show. This is obviously a big topic. I think it's one that will continue to dominate at least portion of the real estate news because, as we
Yeah.
know, housing is something that everybody seems to be concerned about, certainly after some of the natural catastrophes over the last few years, and especially one here in Los Angeles and earlier this year. It acutely points to sort of how we really need to focus on this more and figure out a way how to get more of it, essentially, right?
Yeah. Yeah. And the reason I brought up the presidential candidates is because some of the things going on in the West Wing are going to have an impact. Your editorial perspective on the impact is flexible, but to say they're not going to have an impact is sort of silly. Most of all, I think the narrative for me is that it's nominal, is that it's not as significant as some consumer focused headlines may want you to believe. And I was speaking with a different economist this morning, and he agreed with me. Yeah, goods may cost more due to tariffs. Building and construction may cost more due to changes in immigration regulations. But does deregulation completely offset that and it's all basically a wash?
I don't know. I'm going to counter that a little bit by saying I'm not sure that is going to be that nominal, and it's okay to disagree. I think. I guess it also depends. It depends. Depends what ends up happening. What ends up happening with the tariffs. What ends up happening with deportations. It depends on what happens with interest rates and how
Right.
they're impacted by inflation. I think deregulation, helps in certain places. But as you and I will talk about this in a few minutes, there are a lot of parts on the West Coast where there's not a whole lot you can do
Right.
in terms of regulation. And so it does beg the question then, okay, where is it going to be maybe nominal and where perhaps is the impact going to be harsher? The biggest challenge, I almost said opportunity, but I think this might be a challenge initially, maybe an opportunity later, is just that a lot of people don't know. There's a lot of confusion. There's a lot of chaos coming out of
Yeah.
national politics. That's I think taking up a lot of our energy and effort. And I think business in general doesn't like this kind of I don't know if we call it indecision or chaotic sort of times. One of the reasons that the market did really well, kind of post election, is that we finally knew who was going to be the president. We finally understood where the country, at least at that point, was going to go. We're back at really not knowing a whole lot, and I think it's probably scaring a lot of business people.
Sure. I was on a call with a colleague, and he reminded me of kind of a cardinal rule of real estate, which is interest rates are important, right? They come and go, but they set it a norm, and we reestablish our business based on them. The thing that investors hate more than anything is uncertainty, and it's sort of irrelevant if you think some of these decisions are good, bad, will help, will hurt. It's undebatable that we are in a period of kind of uncertainty as all
Yeah,
this needs to shake out.
that's exactly
Um,
right. Yep.
yeah. So, on the topic of housing, one of the biggest debates, and I think that's part of the reason I find our guest so interesting, has been the narrative around supply. Are we underbuilt? By how much? You've seen people say a few 100,000. I mean, I saw someone say 7 million units, which, I mean, hey, I'm not an economist, but I don't buy it. It's not 7 million units. um, so where the hell are we? I mean, like, are we underbuilt? Are we underbuilt only in certain asset, levels in certain regions? And it's really hard to unpack because the data is typically looked at a national level. Um, and affordability, which is a huge part of multifamily, it's not a national topic because living in Tuscaloosa and living in Los Angeles, I mean, the fact that there's a door on your unit is probably the only two things in common.
That's exactly right. You know, it. We're both on the West Coast. It definitely seems that we're underbuilt, right? In
Yeah,
in that space. Anecdotally, we have spoken to some people who are in the Midwest, where it seems like there seems to be kind of an endless supply of new projects coming online. We'll see. We'll see what that means long term, maybe even midterm, right? In terms of some of those numbers, the numbers that I dug up really quickly over the last couple of days show nationally a number somewhere between 4 and 7 million. Now, what exactly does that mean? I'm not exactly certain. I'm not exactly certain if there's a certain region that captures a
right.
bigger portion of that. I imagine states where you have higher population, you also have probably a higher need for development. But certainly, you and I on the West Coast, we understand some of the challenges going on there. We know, for instance, in Texas, building is, a lot easier,
Sure.
especially markets like, Houston. No problem, building stuff there. But that leads to other challenges as well, right? What are your thoughts on some of the kind of regional stuff? I mean, you guys play nationally. You see some of these things across the country. What are some of the things that you've seen?
It definitely varies regionally. And I think the narrative is different in every region. And I think that's what some of these national figures can sometimes miss. So, in the Northeast, obviously, we have incredibly high cost, um, density, and it's all sort of urban and very close to urban, suburban, but it's not really like true suburban the way it might be obviously on the West Coast, where there's plenty of suburbs outside of major cities. In fact, very few people live in downtown Los Angeles relative to the workforce that resides there,
Right.
theoretically on a daily basis. Same goes for a lot of big cities in the West Coast. One of the things that goes around this topic, and we've kind of circled it, and now let's take it head on, is how does affordability factor into all these? Because not all units are created equal, and that's by design. We need to have a varying supply based on demographic, income, markets, demand, and all those free market things. So one of the things that I found very interesting, and it's the big problem to solve here, is in Boston, where there's some new policies to kind of encourage development of affordable housing, some zoning and incentives for developers, and I think that is the main reason why, rewinding to where I started here, I don't know if the impact from the White House will be significant, because in reality it's up to the municipalities, right? They make
Yeah,
so many of the rules.
that's right. That's exactly right. And I think it doesn't help that on the national scene we've got sort of endless chaos. But it certainly could impact locally, especially like I said, if inflation stays where it is, and it looks like it probably will,
Yeah.
based on everything we're hearing, which means interest rates stay up, because
Yep.
those two are closely tied. It does seem that some of the challenges tend to be more coastal. So certainly Northeast, East Coast, West Coast. That's where I think we're focused with challenges. On the West Coast, the biggest issue is going to be just regional zoning. There's something in California called CEQA, which
Yep.
basically monitors clean air. A lot of kind of NIMBYs use that to sort of push housing away. In the sort of Northeast, you've got things like things that are how do I put this politely, old of significance, historical significance,
Yeah,
right? So it
sure, sure.
might be challenges in terms of like building there. But also jobs. Jobs is what's going to drive a lot of this. Development is going to drive, obviously, commercial is going to drive retail. And so I think if we see a disparity in terms of where the job growth is happening and where the housing production is not happening, then we're going to see a very acute problem in that region continue to dominate sort of the discussions, right? Also, everything we're hearing, I know there's a couple of municipalities that have passed some laws around, um, you know, tax kind of, making taxes sort of pay for some of the conversions
Right.
or not paying taxes, right? I think that's also sort of city by city, county by county. Um, on the whole, I think aside from like New York, it doesn't seem like the office to housing conversion is going to be taking foot anywhere. And I know it sounds
No.
great. It sounds like a really good idea financially. It just makes very little sense, and that's not going to help us. So
Yeah.
back to zoning and back to sort of trying to figure these things out, right?
It was always an overblown headline, the
Yeah.
office to residential conversion. It just doesn't work in mass. We have some case studies here and there, and of course, there was a big one recently. I think it was in Los Angeles. There was announced that there was going to be a big tower was going to get converted. Um, but relative to the distress in the office market and the need in the housing market, it doesn't make a dent on either side.
Yeah.
I don't
Yeah.
think in any significant fashion.
Yeah.
And that's it's two other things that I will say, and I don't know if I think we should do this pretty regularly here. Two things really surprised me this week, and one of them is off of this. So, according to RealPage, which an authority, job growth should not be the only indicator of apartment demand.
What
It is
else?
not the strongest indicator, in
Okay.
fact, of apartment demand. Now, their contention, which I mean holds water, but they didn't have a solution, is well, it's hybrid work. It's work remotely. It's just because your job is in San Francisco doesn't mean you even reside in the state of California. So while developers, I mean, as long as I've been in the business, have been hanging their development plans to job growth, maybe it's not as clear cut as go where the jobs are, because the jobs are everywhere.
Yes, I am curious if that is a sort of a long standing, whether that was something that we picked up during COVID or whether that's going to be that way going forward. One of the things that we're seeing, and I'm sure Elliot, we chatted about this, is companies are now pushing people back into the office.
Right.
And there's been headlines. Amazon was probably the most prominent one in the last quarter, in the fourth quarter of last year, just to come up and basically say, okay, enough is enough. Apple has never really announced it, but I feel like they're
Right.
back to something like 97% from some of the reporting that I've seen. So that means they're back to where it needs to be. We talked about J.P. Morgan. We mentioned Citigroup, kind of going the opposite way, but Gap last week announced that they're pushing everybody back into the office as well. Dell, computers. I think we're going to see folks coming back. I have spoken to one head of real estate for one tech company that's got probably 9 or 10 offices around the world. They are starting to bring people into the region. So
Okay.
if even if you, let's say, live outside the region, like they're not going to obviously let you go, but all new hires are being done kind of in the proximity of the office within something like 50 miles or something like that. So because they want those people back into the physical space. So I do wonder if we're going to revert back to the mean in terms of housing following that, if in fact we do sort of approach maybe the 90% occupancy or whatever the new norm is going to be. That will be something that's super interesting, I think.
Yeah, and occupancy and rent growth are in multifamily fundamentally the name of the game. So we have this interesting confluence of events that I'm not sure will pay a ton of dividends in 25. So all of the people who 2 years ago were saying survive to 25, I'm sure you heard that terrible thing.
Stay alive to 25,
Uh,
right?
right, is that what it was? Stay alive to 25.
Yeah, it
Um,
was some
I,
version of that.
I don't think that's entirely right. I think we're looking late 25, early 26 if I was wearing my economist hat, and here's why. So, obviously, from a development perspective, we let off the show talking about rising hard costs and construction costs. So, developing is still going to be pencils down for the most part, the way it has been for the last, I don't know, 18 months. So, we're looking at mostly acquisition and disposition, which of course doesn't bring any more units online. And then rent growth is expected to begin its sort of upward trajectory again this year. But what I'm hearing, and I think this was kind of the conversation at NMHC as well, is that it will be somewhat. It's not going to be significant. It's not going to be 7, 8, 10% rent growth. That's just not coming. So it's going to be 3 or 4, which is in normal times healthy. But when you have that level of rent growth with construction starts pretty much flat and demand ridiculously high, we have all of these different things that are going to kind of meet somewhere, and it's going to be messy.
It is, and I think it goes back to what your cost basis is, right? Especially whether you're developing or whether you're buying, whether the sort of average rates, rental rates make up for where you're thinking to be. I think that's going to be a big differentiator. Um, that I've sort of caught my eye for this week also was around kind of housing production, and I looked at basically multifamily production in 2024. You mentioned that number earlier of about 7 million, and that's probably on the high end, maybe probably too high, right? But let's assume it's somewhere around there. Across the country, around 770,000 units were delivered. Most of it came from looks like New York, which led the nation with about 33,000 units. Dallas about 32, 33. Also Austin about 21,000 units in 24, which is incredible. Phoenix 20,000 units. Atlanta about 18,000 units. The interesting thing about this is that 770,000, if we believe that 7 million number or whatever it is, that's about 10% of where. So we really made a dent of about 1/10 of where we need to be. That, supply and demand kind of tells you housing will probably continue to be a challenge. It is also one of the biggest driver of inflation, core
Yep.
inflation.
Yep.
And so these things go hand in hand. It's not just what happens in Washington. It's also, how much of it do we have so that we can price it appropriately. And right now, it doesn't seem like we have enough.
No.
Is kind of how
No.
I'm reading it, right?
Yeah, and you have to remember the 770,000 is delivered in 24. That's kind of a running, I don't know, let's say 18-month, 2-year, 3-year kind
That
of
started in
horizon.
22,
Right.
right?
So in 22,
Right.
23, when the economy started getting pretty challenging for developers,
Yeah,
the pipeline, it's
yeah.
not very robust. So
It's not that
last
big.
year's
Yeah.
figure, to your point, making this very small dent, it's going to be a smaller dent in 25 and an
Hmm.
even smaller one in 26 in all likelihood.
Yeah.
So I know that it's the job of an economist to look at not tomorrow or the next day, but kind of down the line. But I think 27, 28 is actually still when we're going to see a peak housing issue because demand will continue to grow. It's inevitable, but supply is not going to be able to keep up remotely.
So, Elliot, I have a new saying that we can start using. You know how you said, survive until 25 or whatever, right?
Yep. Yep.
It'll be great in 28.
I love it. I might start using that. I used to tell colleagues at work, it was get your kicks in 26,
Okay.
playing off the Route 66 thing.
Yep. Yep.
Yeah, but and to what you were saying about the regions that led in development, I mean, it goes back to what investors, developers, and the population has been looking at for a long time, which is the Sun Belt, which is the places that are affordable to live because, you know, love it or hate it, a six-figure salary anywhere on the West Coast is like no big deal. That's not going to get you the American dream, not in any way, shape, or form. Unless you're in like Mendocino, California, or whatever. But um, go to Houston, right?
Right.
And I think that six-figure salary probably gets you something akin to a palatial estate. Um, so that also just underscores that the problem in the gateway cities and on the coast is only going to increase because whatever we are developing, it's not at our biggest job centers. It's not in Los Angeles. It's not in San Francisco. New York, yes. It's not in Chicago.
Yep.
Chicago's nowhere on the map. Developers were, as you know, very, very hot to trot on Miami for quite a while. But something you mentioned earlier in terms of weather events, people are getting scared of Florida because the insurance costs related to hurricanes.
Yep.
We've been
Exactly.
hearing that now for a while.
And it's not going to go away. I mean,
No,
that's that's not a political statement. It's
right.
just where we're at. So that's going to be interesting. Yeah. So, well, good. All right. Well, it's an interesting topic. Continue to be an interesting topic, and I'm sure there'll be a lot of other opportunities to talk about,
Oh yeah.
housing.
Oh yeah. And I'll leave you with this bit of a cliffhanger for you. So soon you'll be hearing a conversation that I had with Brad Dillman. Brad was previously chief economist at RPM Living and Cortland Partners, both of which in the top 50 NMHC list. He did some time at Pulte on the single family front and also at CoStar. So he's done the rounds in the housing and multifamily space. And the cliffhanger is he says we're approaching being systemically overbuilt. How's that for a turn?
Looking forward to it.
All right. See you next week. All right. So I have with me here Brad Dillman. Brad, good to see you again, my friend.
It's good to see you too.
So, for those that don't know, Brad was formerly the chief economist at Cortland and RPM Living. He's worked at Pulte, CoStar. He has the Chartered Alternative Investment Analyst, Financial Risk Manager, and Risk and Artificial Intelligence designations. I mean, your signature in an email could be one of the most epic things if you really wanted it to be.
Yeah, no, it's always fun. 10 letters after your name, you know?
That's right.
It's
That's
good
right.
stuff.
So obviously the topic is housing, which kind of really never goes away as a topic. I want to say it's hot right now because of the election, but the fact is I can't remember the last time that housing wasn't like a hot topic, at least in my time. So 50,000 feet, where is the housing market? Everyone seems to be talking about interest rates, high pricing, we're underbuilt. All of that is very confusing and seems to be bumping heads at sometimes.
Yeah, and I think it's changed over time too. I think the easiest way to discuss where we are today is to think about where we've come from. And I think we can all look back at the history of the 21st century so far and say, hey, I think we had that housing bubble thing. And during that housing bubble, which occurred for a variety of reasons, we ended up building too many homes, right? And that eventually came to a head where all the credit that was sustaining that, all the financial engineering that was sustaining that, all the even fiscal interventions like the American Dream Down Payment Assistance Act, things like that eventually kind of petered out or didn't have their marginal effects. And we had the GFC, right?
Right.
And we were overbuilt by some amount of units. I think we can all agree that when home prices fall as far as they did, right, that had some kind of supply side component, right? And indeed, we saw the whole industry kind of shut down for a while with very little, new construction. Now, my take on that, we spent about 40 years trying to reflate the housing market. We held supply off market. We intervened with interest rates in particular being a big one. We did a couple of first-time home buyer credits, different at the state level too.
Yeah.
And home prices really started to rip by 2012. And they ripped really because of this policy called Operation Twist, which pushed the 10-year treasury rate negative in real terms. And if you look around at the home price indices at that time, you see year-over-year home prices just take off. Now, anybody who lived through that would remember that that's really weird because the number of full-time jobs we had at the time were at 1999 levels, right? Despite the fact that millennials had been entering the labor market, despite the fact that, the elderly were working at what was then some of the longest, rates ever. So to see home prices go up, 10%, across the board, a little questionable, right? And essentially what we ended up seeing was this take effect, right? That home prices started to take off. We then had a constriction with that came from the taper tantrum in 2013. And I think that was something that really just all of a sudden was the end of that distortion. So we'd inflated home prices and now there was a removal of affordability and all of a sudden they couldn't really build in scale. There was such a small domain of the market in which supply could be delivered and that people could also purchase at. And then that was the heyday of multifamily, right? If you look at that same thing, there's the taper tantrum in mid 2013. You look a year later and most major rental indices, and you see a little pop in rent growth. The golden age of multifamily, right up through there to call it 2018 or so. And this is where it was interesting, right? I came around to the underbuilt arguments in late 2016, early 2017. The data I'd seen prior to that showed us that we were still overbuilt in like 2012, 2013, right? So we inflated the housing market when we were still overbuilt by about 1 million units, at least based on my estimate. And we ended up then going into an underbuilt situation because oddly, and for what was basically a depression grade labor economy, we continued to add people via immigration, right? The number of full-time jobs that we had in late 2007, right before really things started to break, we didn't hit that number until mid 2014. Okay. So it was like 7 years of net zero full-time job gains and all kinds of other movement, in the economy. But basically we had a lot of supply coming in late 2018 and multifamily in particular. If we think back, there were a lot of concerns about this was going to swamp the market and it ended up not doing that. Not only did vacancies not rise, they actually went lower. And then, of course, we went into the collapsing 10-year treasury rate in 2019 and started to see a bit more single-family activity. Now, by my index, we kind of hit the peak underbuilt in late 2018. Thankfully, it was because we started to build new supply, but it was also because we reduced immigration a little bit in the first Trump administration. So by reducing our population growth and building more housing, we started to right-size it. And then the cat got out of the bag and with the pandemic, right? I think we ended up basically stimulating housing supply de facto.
Yeah.
When we pushed the 10-year treasury rate negative in real terms again, right, through the monetary interventions in the pandemic, we basically made mortgages really affordable. And this time we saw supply be able to respond to that. We gave builders zero interest rates again. And we did eviction moratoria that stimulated occupancy rates and then by that rent growth and made every single development deal pencil wonderfully, and everybody started building, and then we've been dealing with that supply over the last year and a half, 2 years. And I think that's where we really hit the curve, right? We started to add a lot of supply really quick, and then we started to grow our population really quick through the scale of immigration we've had over the last 4 years. And the two have kind of moved in tandem. And then the question is where are those two moving together? Well, I look at that now and I see a couple of things. I see rent growth that's been 0% nationally for a year and a half. That means in inflation adjusted terms, it's deeply negative, right? Especially when we think about how inflation was a bit higher, months and months and months ago. That also means, and at the same time, wages have been increasing. So our rent to income ratios have reset. 0% rent growth indicates to me that nationally, that there's, probably tilting closer to the oversupply side than the underbuilt side. Okay, fine. Let's look at the single family side, right? What's happening with annual home price appreciation? Well, it's like a little over 3%, 3.6%, I want to say it is on the Case-Shiller National. You adjust that for inflation, it's not even 1% in real terms. And mind you, these are just the ones that are transacting. The single family market's having to be supported by existing home sales that are at Great Recession levels. So you're talking about very low volume to support what is very, very small real home price appreciation. And then again, we've got this 0% rent growth in multifamily. So it's kind of an interesting dynamic. It's hard to square that to these views that say that we're underbuilt by millions of housing units, right? The popular number was 5.5 million, some people were saying, which again, that's enough to house like 11 million people, about the size of the state of Georgia or the country of Cuba. These are numbers that are very difficult to align. So you ask me where we are today, I'm going to say that we're crossing that equilibrium, that we're passing into a systemically overbuilt phase with a couple caveats. The immigration thing is always big.
Sure.
That's going to be a huge one. We've obviously seen a political changing of the guard, but the reality is immigration functioned as a form of a bailout for housing supply over the last couple of years. Right. And it remains to be seen how that's going to correspond to development activity going forward.
So how do you deal with, so when you're talking about being underbuilt or overbuilt, first of all, everyone still says underbuilt and they still have these astronomical figures. So you're already just a tiny bit of a opposition viewpoint there. But on top of that, when we're talking about very small price appreciation on the single family side, how does that coexist with the kind of running narrative that no one can afford to own a home?
Yeah, and I would say that this reminds me of the situation called a little over 10 years ago. So you've got high prices. If we think about the way real estate's valued, it's on comps, right? So some small section of the market transacts, right, usually because of some incremental expansion in credit. We capture those prices, and then those are imposed kind of on expectations in the rest of the system. Now, in our case today, we've got very, very low transaction volume because the reality is, I would argue, we've because of credit interventions, have kind of stimulated home prices more than a freer market would have otherwise allowed, right? Had we not crushed the 10-year treasury rate, right, through monetary interventions and pushed it lower than it otherwise would have been, and therefore long-lived assets like real estate higher than it would have been, we wouldn't see this situation today. And this is why you get this weird situation where people are in a home that they bought years ago that they couldn't afford to buy today, even with a very low interest rate. Right?
Well, forget years ago, Brad. I bought my home 6.5 years ago. I'm not one of those people who bought it, in the 80s for a nickel. So, of course, it's somewhat realistic that they wouldn't be able to afford them at modern prices. I bought my house 6.5 years ago, and I remember the residential broker, looking at me and saying, just so you know, I'm never going to talk you out of buying a home because it's my job and I get a piece of the pie, but we're at the top of the market. And I looked at him and I said, well, residential, there's really no top over a long enough timeline. So if I'm going to sit in this house for 10 plus years, the odds of me not seeing value is, fractional, especially anywhere near a gateway city, which I am.
Yeah, but we have to question that in real terms too. And that's one thing where I think if we look at the way appreciation has been in some of these gateway cities, it's not necessarily in real terms. Or what we're starting to see is a lot stronger real wage growth in areas like that, right? But I think the question of where and when home price appreciation is real, or is it just something where you're basically hedging yourself, right? Where you're not stuck in the apartment getting inflated away like the classic millennial story of like call it 2010 to 2016. So that does become a different point to think about. I think the other side too has been, and Ben Bernanke was famous for saying this. He said, I want to say he said it in '07, right? We've never seen a decline in home prices on a nationwide basis, right? According to the data, right? Anecdotally, that's what happened, in the Great Depression.
Sure.
But it's a very rare event, really, to see meaningful declines in home prices in such a way that one actually is losing money on it. One might not get the best execution or sell at the best time. You go, oh man, if I sold last spring, I would have made X amount more. These are obvious questions. But yeah, otherwise you're running into a situation, I'd say, where people are pretty well hedged. But to answer the question, right, how do we have these high home prices yet nobody can afford them? I would argue it's because of these movements in interest rates that don't actually reflect the conditions of end user consumers, right? We have interest rates, we have mortgage rates that are priced off the 10-year treasury rate, which is at this point openly manipulated by monetary interventions, right? We don't call it full yield curve control in this country. We just call it QE. But the reality is when the Fed's out there buying treasuries or CMBS at the long end of the curve, right, it's affecting those spreads and those interest rates. Operation Twist in 2012 openly was pushing down the 10-year treasury rate. Janet Yellen wrote a paper about it, talked about how we pushed it down 120 basis points lower than it otherwise would have been. Now, what that meant is home prices went higher than they would have been, and that meant that a lot of people that didn't get in at that time had to delay, downsize, and migrate. And of course, we saw all that action over the subsequent decade, and we've gone through a similar part over the last several years. It's just now confounded by a little bit of acceptance on remote work, at least among companies that don't have big office leases and need to force people back in, and pretend like it's not because it's just because of their office lease. But it's a little bit different this time. But I think the underlying piece of it's the same. We pushed the 10-year treasury rate negative in real terms as part of our COVID response. That had that impact on the housing market that we saw today.
So I want to ask you about development, but before we go there, the interest rate question and the housing affordability question, I want to drill on a topic and really see where we go from here. So, as I mentioned, I am one of those people. I could not afford the current home I am in if you drop the interest rate to zero. I mean, it doesn't matter. The interest rate's irrelevant when the price is what it is. How does that change over time when, because of that, someone like me, who in the next, let's say, 5 years should be looking for their second home, probably will not be able to? So the conventional starter home, which maybe is honestly just a term that we should put to bed, maybe it's just outdated. How does that work with supply? Because if I'm not upgrading, houses like mine are not available for first-time buyers.
Yeah, I mean, that may be the perception today, that maybe in a situation where you'll never be able to transact that home. But let's remember, we're in an environment with very few transactions today. And I think that there's a case to be made that there are savings accumulating in the system. Not only these, again, you look at like the young millennials or the older Gen Z, it's never been easier. Right, you've got, if you're in a Sunbelt city, your rents are down year over year. You're paying lower in rent in some cases today than you were in 2019, but your wage in many cases is higher by 50%. Right, so these people are accumulating income or savings, and candidly, I think supporting a lot of the consumption that we've seen too, and some of this marginal inflation.
Right.
So these are folks that will end up putting down larger down payments. There are people who'd be able to buy your house. The question will be, what will you do?
Right.
And then the question from that might be, what's future interest rate situations? What other interventions might we see that would somehow transfer affordability to you as a move-up buyer? We've seen first-time home buyer credits, but maybe we'll see something different in the future. We don't really know. One thing that I've always looked at is seeing just how difficult it really is to predict the minutia of what it is that kind of keeps the market going, but it sort of continues to churn in some respects. It may be a continued acceptance of different living arrangements, right? Where all of a sudden you're able to move to out of your gateway market, sell your home that you couldn't afford today, and buy something that is cheaper, you're keeping some savings, or you're rolling it all into a property, you're not paying a mortgage. And then somehow, because of the way wages have continued to move, that at least in nominal terms you end up making the same or maybe even more. These are all open to question. But if, let's say, none of that happened, let's say we were in a situation where you're basically trapped because you don't have a marginal buyer, or even if you did, you don't have a marginal place to go, right?
Right.
Because even if you sell your home today, you're not going to get one that's as good for what you're going to be paying for it. So you just say, well, forget it. I'm not going to sell my place now to downsize into a smaller place when I'm trying to have a family, right?
Right.
That becomes, I think, a really interesting question where a lot of people, at least in the short run, may be trapped. And we did see something similar to this during the housing bubble and the subsequent Great Recession. And that was people getting into condos that they couldn't get out of. And in a lot of gateway cities, that was the case. And it did impact people in the sense that if they were at a life stage where they wanted to have a family, they were constrained because they were stuck in their condo, which, at least they kept because of, the mortgage rate refinancing, and because maybe they kept their job and so on, and dual income, which is common enough now that if one person loses a job, the whole ship doesn't sink right away.
Right.
But I think you raise an interesting point, and I think that is one where we tend to hear it more on the other side of these first-time home buyers having a difficult time. I think that will ease. I think the question will be how many previous first-time home buyers who would now want to be move up are finding move up to be the most effective means forward, or is some kind of downsizing in some way, like by moving, getting better product further away, for less debt, more attractive.
Yeah, and hybrid work is going to have a big say there. I mean, I know it's like the topic du jour, but I mean, the theory is if you wanted to work in, I don't know, let's use the finance industry as an example. You looked very strong at New York and LA and San Francisco, and regardless of your wage, you were going to pay some home and rental prices due to the very metros that were quite substantive. Now, and we'll use what you said about selling one's house and moving away, and I'll use me as an anecdote because it's really easy. Sure, if I sold my house and moved to I don't know, Kansas, I'm sure the home I could afford would be pretty solid. So it's all still going to be tied to gateway cities, but maybe employment isn't as much.
Yeah, I mean, I think we all know that some element of work from home is kind of here to stay. The hybrid approach, I don't want to sound like Nostradamus here, but what was predictable. You could look at the density that we were getting in some of these major cities. You could look at the commutes, which were getting outrageous, and you could look at affordability, where a lawyer in Boston's got to go live in Worcester and commute, that whole way, even though they've got the big law salary. Things like this that just didn't add up. It was simply too inefficient to move that many people around that frequently. And I think what we will see, and I'm finding it suspiciously interesting, and maybe this is just the way we all like to laugh at corporations and their decision making, that people aren't looking at macro hybrid models, right? We talk about hybrid like, oh, we're in the office 3 days a week. Well, why don't we do something where I'm in the office for a month and then gone a month? Last time I saw, there's a lot of high rises over there that need people to live in them. And there's a lot of, Airbnb style things and corporate housing and things that can bring people in. It's a testament to the complete inability of large businesses to innovate or actually be thought leaders that you don't see this popping up yet. Because your ability to get a much larger labor force, right, get anybody in the country, right, to go anywhere else at given times is far more effective with a kind of macro hybrid model like that. Instead, you see much more of a focus on, well, we're in the office 3 days a week, 4 days a week, or here, or all the time, and that kind of thing. Or you see the full remote thing, where it'll be a company that's removed any kind of office space altogether.
Yeah, and the costs associated. So we've talked a few times. You've mentioned things like intervention and policy, and you did sort of skate around it. But let's go right into it. The changing of the guard in Washington D.C. So one of the big topics is something you've mentioned a couple of times already, which of course is immigration and the commercial market. Commercial real estate is heavily impacted by immigration, whether it's in the blue collar work at construction sites or hospitality. A big misnomer, of course, is that immigrants are generally lower income. That's not necessarily true at all, at which point retail spending is affected. So, what kind of policy shifts that may or may not be made would impact commercial real estate the most?
Yeah, first I want to say you're right on the immigration front. Pew surveys show that over the last decade, legal immigrants were handily more educated than the U.S. population on average. So this has been a bit of a subtext. It's been a bit ignored. Obviously, immigration is such a sensitive topic that, frankly, we don't hear candid conversation about it in most dialogue that's outwardly facing. But I would submit that what effectively has happened to white collar wages in this country is what's happened to blue collar wages after deregulation and after NAFTA in 1994. And that's to say that it's been very stiff competition on the white collar wage front in order to have wages that in real terms are strong enough to provide what was, let's call it, an upper middle class lifestyle by the standards of the year 2000. But as far as policy, well, let's start with immigration, right? Obviously, that's kind of the big one. Trump ran on some of that in his first go at it, and then of course he's mentioned it again.
Yeah.
He did have a slowdown in immigration in his first term, and it's again a testament to sort of the narratives in our society. Unquestionable, it was needed. Like one of our problems was, and we see this today with like some of the narratives in Canada or the UK. There's been so much immigration that just to slow it down now is a problem. And that's kind of where we were. So we had that slowdown that actually helped right size our housing market a bit. And then we did stimulus that's kind of set it off in the direction where now the immigration that's been significant in the last several years has helped bail it out. But I have to wonder what will happen on that front. And it's weird to me because obviously you've got Elon Musk involved in some of this too. We've got, the AI is going to take over, right? Bloomberg Intelligence just had a thing, 200,000 Wall Street jobs to disappear over the next 3 to 5 years. Well, tell me why we need massive white collar immigration. I don't know, right? I can't answer that question, what the policy wants or what the goals of having this scale of immigration are. But what I can tell you is that marginal immigration, if it's competing with local labor, obviously pushes down wages, right? We've seen it time and again in history that if population slows down or even declines for various reasons, the most famous one is that thing that we called the Renaissance after the Black Death, right? When the population declined in Europe and wages went up, and that led to it contributed in part to the Renaissance, some people would argue. Now, so if we had a slowdown in immigration, I would submit that we will probably see some support in the labor market and continued wage gains. On the other hand, we would see that reign of quantity growth that we get from immigration, right? Just if you're bringing in more people every day, they have to be housed, they have to be administered and integrated into society. They then provide labor and so on and so forth. So there's no doubt that incremental growth wouldn't be there. And we would have to understand how that's really going to be made up. Now, when Trump slowed down immigration in his first term, right, he only slowed it down to like 600,000. Only like 600,000 people in 2019, right? So you're still bringing in plenty of people.
It's a relative term, of course.
Yeah, it's a relative term. So the question becomes, just what would happen if it actually did slow down further. Obviously, we can already see the politics at play here where it's, we're just going to enforce illegal immigration, but we'll actually increase legal immigration or whatever, even though you're all going to be unemployed because of the AI and we'll put you on universal basic income or whatever. But anyway, that's the big one is immigration to me. The other one that's far more opaque is things like the tariffs and what their minor impact are going to be on different industries. And then whatever big bill that they're going to get through, and I think people would agree that there's going to be some kind of bill that gets through this year. What is going to be in it? Is it going to, it's probably going to extend the tax cuts in some ways, but what else is it going to do? And I don't think we have a lot of clarity on that yet. But as far as housing, its biggest one, in my opinion, is immigration and how it's going to affect marginal demand for housing. The other side of that is the freedom cities, right? You can't build 10 new freedom cities without radically increasing legal immigration. And I think right now that's the dialogue that's happening within the Republican Party and in DC in general.
So I have one very tangential question to ask you, but I want to follow up on that and really put you on the spot. I mean, the past couple of jobs you've had, the title's chief economist. So profess to me, where are we going to be in 2 years? And of course, I understand you already referenced Nostradamus, which I love, by the way. Understanding that a prediction is just that, where are we in 2 years?
So I think we've been in a reasonable slowdown in the last year, right? I think that this changing of the guard. It's typical that you're getting a slowdown approaching a new administration. We now have a congressional clean sweep, which means the likelihood that we get expansionary fiscal policy, this big bill that we just discussed, in place and going out, that should stimulate the economy over the next 2 years, that tactical kind of like 2-year move, as an expansion. The question will be what happens when the Republicans may or may not lose, say, the House or the Senate in 2026. And I think at that point, we'll then be going into a lame duck, or we'll be in the lame duck presidency, but the last 2 years of it, which historically are kind of supported by monetary policy. And so we may see some cuts then, and then we'll see whatever big show is going to happen on the 2028 front with politics. So I'd say we've been in a bit of a slowdown. We're likely to see a little bit of an increase here. I think on the multifamily front, as an example, we've clearly seen the bottom, I think, in the impact of supply, and seeing these massive absorptions that are occurring due to the population growth that we've had, to support that scale of supply. And I think it's pretty common that people are expecting rent growth in the second half of the year, and that would sort of reflect that general bullish dynamic as we tilt into the new administration. So I'd say the worst is, kind of call it late 2023 and then across 2024, certainly spring 2024 through the end of 2024. We can see an echo in that, actually, if we think back to the Obama administration, right? We had that first rate cut in December 2015, and then we had to double seasonally adjust GDP to keep it positive, for 2 quarters, and sort of bypass the fact that we were basically in a recession. Industrial production certainly had signaled one at the time. To answer it, I think a tactical improvement over the next couple of years. Where it puts us in the housing front, I think, is a little bit more of a question. That's going to depend on this population growth stuff.
Right. Yeah, because population.
I had told a very wealthy man once, in 2021, I was looking at the inflation data, and I was like, there has to be like 1 million plus people coming into the country for this to happen, like more than normal. And I was backing into the idea that there was this big population growth that wasn't covered at the time. And I told this guy, I said, if you want to start a business, create something that is getting real immigration data, because we simply have no idea. I can look at cell phone data for domestic migration patterns and activity, but the immigration data, like where are these people coming from? Where are they going? That's something from a housing perspective, given that that's the marginal demand in a country that's had a below replacement fertility rate for 60 years, except for a handful of them at the peak of the last housing bubble. Like this is something where immigration is extremely important. Never mind like people's sort of views on it from like a non-economy perspective,
From a social perspective.
but in the economy, social, cultural, whatever. Okay, like everybody can have their view, but just in the economy, no matter how you cut it, bringing people in creates marginal activity. I'm not putting a value statement on that activity. I'm just saying, if you take it away, you're going to see a slowdown.
Right.
And if you increase it, you're going to see an increase. And I think the case to be made today is that we're going to see removal of illegal immigration, or at least an enforcement on that. And I would bet, based on what we've seen, an increase in legal immigration, or at least its maintenance of the status quo.
We could go on the topic for hours, I'm sure, but there's one thing completely out of left field that I want to ask you about. As in most real estate firms, chief economist kind of falls into the research department, fair or not. That's sort of where it is. All my years in real estate, perhaps my biggest bone to pick is with research. Typically, brokerages are notoriously bad, but why do we still put out research like a quarterly office report that comes out 45 days after the quarter is over? And of course, no one says this publicly, but I will. No one reads it. So even if it was very time-sensitive data, I don't know that it's consumed at any appreciable level.
That's an interesting question. Yeah, I'd say for it coming out late, right? Some of these data points are not collected yet, at least historically.
Sure.
Now with more real-time collection, maybe people can have more real-time views. I think the thing that's interesting on research on that front in general is you'll get these big narratives, these big to-dos, these big sayings that some people take account of a little bit, but at the end of the day, they tend to not really affect a specific investment decision.
Right.
I think a lot of it's marketing. I think that and we see this now really on the data front, where there's a lot of window dressing. If there was an order to research, I'd say if you're really small, you can't even do research. You just got to do whatever deal you can. You get a little bit bigger, people start expecting something out of you. You at least need to have some research in your deal memorandum. And then you get a little bit bigger, and now you need to start having slides and a fund deck and everything. And you can bring in some salesman guy or marketing guy to put his foot in his mouth because he doesn't know what he's talking about. But half the time the audience doesn't even know anyway, so it's no big deal. And then you start to get a little bit bigger. You start to need somebody who actually knows what they're talking about in front of these pension funds and things like this, groups that may even hire other people to validate your fund, right? So in multifamily, this is by the time you're about 25 to 30,000 units, you need to have somebody in-house, right?
Yeah.
And then once you get bigger than that, you can start to do things where you can start explore using data. And that's the thing where I think there's just been a lot of interesting activity on the research front. Like on the one hand, you've got groups where you've got management that doesn't understand the technology. The first Excel whiz that walks through the door, heads analytics,
Yeah.
Or there's people that can talk a game but have no technical. I mean, you see this. You see people who can't code and they're running an analytics team, right? Of people who do the work. And I can see some people making the argument on that, but I think some people would want somebody who's been in the trenches, who knows where the war is going to go to help lead the troops, as opposed to somebody who's, they glad hand real well. Maybe there's some value to that, but I think when you're trying to innovate within data, that's difficult. The other side on that, sorry, go ahead.
Well, that's the word. You hit the word, perhaps accidentally innovate.
Yeah.
When I entered this business, real estate research looked eerily exactly the same as it does today, at least the perception in the marketplace. And that was more than 10 years ago, nearly 15, in fact. So are we going to see some innovation, and is it going to be soon?
I think we will, and I think we see it in cycles, where the marginal value sometimes is on just a good qualitative game, and then other times it's data, and now obviously with AI kind of merging the two, it's going to be even more interesting. I think that the hard part is look, if you're a business, right, and you invest in real estate, to have all the extra money dedicated towards buying data sets, which aren't cheap, buying the people, which may or may not be cheap, but which in any case you don't understand at all as the business operator, right? You don't know,
Right.
You just hear machine learning and AI, and your eyes glaze over, and you go, wow, that's cool and shiny, and maybe you want to do it. And then worse, you've got the Excel whiz that you might put in charge of that, who also doesn't know it, but you known him for a while and you saw him do something cool in Excel. So you end up with these situations where it's extremely difficult as a small business to really make that leap, or even a larger business. It's a serious commitment where you either do it and it works, or you've wasted a lot of money. And the way in which you can lose money on that is deep. You can hire the wrong talent, you can hire the wrong leadership, you can not listen to the right people that you hire, right? At times, you could just hit a bad part of the cycle, and it just doesn't get the full distance. You can get a data lock-in effect where now you've got some data feed that you're reliant on, and then you're going to have to pay some increment more every year to them. I think a common thing that occurs today is people thinking they're at a certain infrastructure level, and they're not. So that they're say data warehouses in a situation that it is not yet, or that they'll have certain connectivity to outside providers that they don't have, or that they want to achieve certain things before they build that kind of connectivity. And so I think those are themes that I'd say are pretty important. So I do think we're going to see this innovation. The data itself is becoming more plentiful. The skills to do the coding are becoming more plentiful. Even the ability of people to be both, say, a technician or coder and have a domain expertise is also increasing. So I think we'll just see more integration of that over time. But how companies get there, I think, is going to be a different question. There's always going to be that demand for a third-party provider. There's always going to be that leap where if you just do a little bit yourself, you're getting a little bit more. But how do you really get to those big solutions that get so popular? Are we going to see acquisitions of these kinds of companies, down the road?
Right, that's what I'm thinking about. Thinking about the largest real estate companies being publicly traded and investing in building that infrastructure and that research is probably something that the investors are not going to like very much from a quarterly earnings perspective. So, I mean, we see it in the pharmaceutical industry. It's perhaps the absolute best example, where, startup loses millions and millions and millions and millions of dollars to develop awesome drug, then gets $10 billion to walk away.
Yeah.
This happens routinely. I don't know that we'll ever see prices like that to purchase a real estate prop tech versus a prescription drug. Um, but that has to be on your mind as a sort of a tech focused research person is the large companies probably can't afford to develop it. Let me develop it and then sell it to them.
Yes, and I think we will see more activity in that because as more people are building products as well, there's only so many people out there who need, awesome solution for, single family homes with 3 bedrooms or whatever it is, right? It get more and more specific, and the size of the potential customer base is smaller, or at least you're dealing with more competition within it. On the other hand, though, this is real estate, and real estate's not known for its IQ, and it's not known for science. Pharmaceuticals, you're dealing with science, you're dealing with things where there's a wrong answer. In real estate, you'll have people who will, frankly, even be unethical with some of the things that they're saying about how they're selling a deal or whatever. And so, in a world where even the research ends up becoming a form of marketing, right? At least for huge stages of it, how valuable is that AI solution that's put together by some Oxford and Cambridge whiz kids, and selling it to some large group in the U.S. Are they even going to be making decisions based off of that, or is it still something where their decision making is, well, here's where the deals are, and I got to deploy capital? These are things that end up becoming really interesting to think about. Now, my own view as a researcher is you need to combine all that. Right, you need to have your finger on the pulse of this market. You need to have some kind of analytics, and it's like a Venn diagram where you're overlaying it. And I think these large groups will understand that too. But I think there will be a potential room for some analytical solutions to be purchased by groups that would actually use them. I don't know if you would see groups that would want these for marketing, really, right? And oftentimes that's really why they get the research person anyways. They go, here's a box I need to tick because nobody's going to want to give me millions of dollars if they find out that all I'm doing is just going through my Rolodex and calling, my buddy and these people who I've known for years and do deals with. I need to have at least the illusion of some kind of science or guardrails around what I'm doing. And I don't think they'll buy the solution. But we'll see. I think overall we're moving in a general direction where it may be easier to purchase these systems than to develop them. And I would also say it's more interesting than renting them, right? The standard solution right now is people build these things and then they want you to pay some amount per year for access to it. But then it's like, well, this is the same thing they're using and they're using and they're using and they're using, and they're all the same forecast, so we all have the same conclusion. Or maybe I can tinker with some things, but not a lot. But it's not bespoke enough for me to find final value in it. And so we'll see some of that shake out. But again, I just want to highlight that in this industry, and for the people that are making decisions in it, they're certainly not thinking within the framework of how these kinds of data and research analytical systems operate and how they're deployed. It's rare that you'd see that being at the forefront of some decision makers' minds.
Yeah, I mean, it's still like the worst kept secret in real estate is despite all of our drive to be data driven, most deals are still done through a cell phone relationship and a Rolodex, which Rolodex, the term is probably 50 years outdated. Um, but yeah, I mean, I guess the inflection point, does it have to be a cultural shift? Does it have to be that the people who are transacting are not looking at the same black book they've had for 25 years and say, frankly, I can earn just enough. I can get done more than I ever want to off this black book. Why would I teach an old dog new tricks?
Yeah, and there's always going to be that component. Again, like if you're a small shop, you don't have an option, right? You got to do it that way. And that's going to be a better decision. I think there's cultural shifts for sure. My own discussions with people, if you've got people that use the term variance to mean difference, they're simply not going to be data people, right? You have, and this isn't to we all have our own expertises, right? Like this is simply to say that you're going to only use data in a certain way if you can even begin to understand it, right? If it's too scary or you don't understand, I mean, I've seen this, I've heard this with my own ears. You see indices of how home prices are moving. And it's like, okay, yeah, I invest in single family real estate. Okay, well, here's where we think home prices are gonna, rise and fall, and here's the segments. That's great. What do I do with it? And it's like, well, come on, man. Like if you're like a national investor in single family real estate, and I'm telling you to buy over here, these systems are like, you at least entertain that, or you start to integrate it into automating underwriting systems that are looking at every deal that come to market and providing underwriting inputs and assumptions to kind of triage the market. So that's like a little bit of a technical side, but then also a cultural side. And it does have to do with education, I think, by which I mean people's understanding of these systems and how they work. And I think that's going to become more common, right? Like, who can't code today that's, under 35, right? I would assume most people probably can, right? If you're a bit older, it's a bit rarer, right? And all the languages have changed so much, pretty soon, the AI will do it for you anyway. So people will be able to jump in and interface with these things a little bit differently, and perhaps in a world where the data itself becomes more questionable. Remember, like 15, 20 years ago, every data point was like real. It's like, oh, you have a data point. Now there's such a plurality of data points that, we can question any of them, or we see the revisions in government data from time to time, and it raises questions. And then we've got a plurality of forecasts now, right? So it used to just be a couple of people in the past with all the data saying, here's where we think, whatever rents are going to go. Now, anybody that can get the data can produce this kind of stuff and embody their own views and what it looks like. So I think that's important as well.
Yeah, and then they can put it on LinkedIn and be a thought leader.
Yeah. And I think that, and now we're seeing that, right? We're seeing that, and this is something I think is a difficult thing in real estate research, is the more one spams, like the louder one shouts, the louder or the more frequent their narrative is put in. And I think that we see in research a lot of circular narratives, just people saying, okay, this person said that, so I'm going to take that. And I think that undersupply thing we talked about earlier is a great example, right?
Exactly.
You get a situation, I mean, right. There's still people saying that today. And fine, if you want to believe that the U.S. is underbuilt 5.5 million units, that's great. But tell me why rent growth has been 0% for 18 months, and tell me why annual home price appreciation is barely above zero in real terms. Just square that circle for me, and I'll be happy to at least entertain the idea that we're underbuilt that much. But if I'm going to read between the tea leaves, right, and I go back and I look at these reports and see who's outputting this information that we're that underbuilt, and see that there's clear political incentives on it, right, and it's clearly political, and I can look at the methodology and go, this is a joke. You guys are PhDs, and you're using just a simple, here's the 50-year long-term average. No. Like, you're supposed to control for something, over 50 years to give me a sense of how the society has changed. But they don't do that, right? So you get these, laughable methodologies, and you get clear political incentives or biases, and yet within the LinkedIn spam world, we don't question these things. And then for people that are operating a business, they've got to spam because they need to get their clients. So we end up in this weird, Kafka-esque situation where, even just doing real research gets difficult, because you've got this thing where people are having to engage in activity to survive economically that doesn't even really make sense. Like having the AI put together some insightful spam post for them, and then putting that on LinkedIn, and then us seeing it and going, okay, and then on we go round and round again.
Yeah, that's a perfect example, because I think the narrative is still that we are underbuilt. The amount of units is varies massively from forecast to forecast, but I don't see a lot of people saying we're underbuilt.
And we don't. Interestingly, there were a couple other people that had said that back that we were getting close, a few years ago. They've gone quiet now, so I'm kind of the only one that says it. And I will say that if we increase legal immigration, I'm going to be wrong, right? Because clearly, if we start bringing in 2 million legal immigrants a year as opposed to like the historical 1 million, or like the even the 1.6 that we've done, right, recently, that we're going to have more demand for housing.
Sure, we have to house.
But right now, like if you knew that was going to be the case, in 2020 before the immigration really kicked off, like, congrats, you got political connections I don't have. But based on where we are today, we're clearly in more of an equilibrium. But if that could change with policy in the future, and in fact, I think that's one of the reasons why people would say we're going to have that, because if you don't have that increase in legal immigration, you're going to need some other way to have economic activity. And it doesn't sound like that aligns, with the AI narrative either, as I pointed out earlier.
Yeah, that makes sense. I think we're going to have you back on just to talk about that research thing. And maybe let's start to kind of explain to people, how do we make real estate research impactful and not, you use the term box check, and that's the term I always use inside my own head when I see these quarterly reports come out saying, okay, you checked your box on the calendar, moving on.
Yeah.
Well,
A report that nobody would pay for,
right,
right? It's,
right,
you're
right.
spending money to give it away for free, and
That's
nobody
right.
would pay for it. Yeah. No, I think that'd be great. I think we could have a whole lot of to say about that, and maybe talk a bit more too about data and the way it's coming together in analytics, like what people are doing, or at least saying they're doing, and how it's actually impacting decision making.
Right, right. Data that's not actionable is, I mean, I don't know if I want to say irrelevant, but probably not super relevant.
Right, and it's just a cost.
Right,
So
right.
yeah, I think we could have a lot to say on that. I think that'll be a fun one.
That's great. Well, Brad, appreciate your time. Brad Dillman, ladies and gentlemen. Always good to talk to you, my friend.
Thanks, Elliot.
All right. Bye bye.